So, if you've been watching gold, silver, or crypto over the last few weeks, you know exactly what I'm talking about. It was a brutal, violent crash that really shook a lot of confidence. And, it's got everyone asking the same critical question. Is the bull market actually over?
Right, this is the big one. This is the question on every single investor's mind. Was that incredibly sharp, painful correction the end of the line? Or was it, just a lot of noise? The answer here isn't just about price. It's about whether the fundamental, underlying conditions that have been driving this market have really changed.
And this is really the core idea we're going to dig into today, and it comes from macro investor Raoul Pal. His argument is that this kind of brutal reset, this big shakeout, it's not the end of the story. In fact, stuff like this often happens right before the next major leg up. So let's break down what exactly caused all this chaos in the first place. What we all just went through wasn't really a single event. No, it was a perfect storm, a whole mess of things coming together. We had overleveraged markets, a ton of political uncertainty, and some critical tech failures that just created this cascade of liquidations that felt, well, frankly, a little out of control. It all kicked off in the metals market. Silver, especially, was just historically overbought. I mean, we are talking RSI readings hitting levels like 97. These are numbers that have only popped up a handful of times, ever. And in the past, when you see that, well, those situations have never resolved gently. They reset, and they reset aggressively. And that really just set the stage for a sharp correction across the entire board. And this is where things get interesting, because it shows this huge disconnect. The price collapse, that happened in the paper markets, futures and derivatives. But if you looked at the physical markets, especially over in Asia, demand was still really high and supply was tight. This split helps explain why the volatility was just so sharp and so destabilizing. Then, of course, a political bombshell hits. Rumors started flying around that Kevin Warsh could be the next Fed chair. Now, why does that matter? Well, the market's afraid that while he might cut rates, he would also turn off the money printer. That's the quantitative easing that has basically been rocket fuel for asset prices. All of a sudden, the market had to price in a world where that flow of easy money just isn't a guarantee anymore.
And as if that wasn't quite enough, the US government officially went into a partial shutdown. This kind of thing freezes parts of the fiscal flow, and it just complicates liquidity expectations right when markets are already on edge. It's just another layer of uncertainty that sucks all the risk tolerance out of the system.
And here was the final straw. Right at the peak of the sell-off, the Binance API for market makers went down. This meant that the very people who are supposed to provide liquidity, to absorb all that selling pressure, they literally couldn't get into the market. So a bad situation turned into an absolutely catastrophic liquidation cascade because there were just no bids there to stop the fall. So, okay, that's the whole messy anatomy of the crush. But according to Raoul Pal, all of that stuff, the leverage, the politics, the tech failures, it's all just noise. It's distracting from the real signal, the underlying state of global liquidity. And this is where the story gets really interesting.
This right here is Raoul's core thesis. Despite all that violent price action, the fundamental drivers are not only still there, but they are quietly turning positive. He argues that we are getting to the exact window where liquidity, financial conditions, and the business cycle all start to line up for a major move up.
Now, to really get his framework, we have to understand this key term, financial conditions. Just think of it like the plumbing of the whole financial system. When conditions are easy, the pipes are wide open, money's flowing freely, and assets tend to go up. When they're tight, the pipes get clogged, money is scarce, and assets fall. Raoul's whole argument is that those pipes are about to open up wide. And here's why he's so sure. He's pointing to a bunch of factors that are all set to hit pretty soon. Bank regulations are changing to let them lend more. The Treasury is expected to spend down its massive cash balance, which injects that money right into the economy. We're expecting fiscal stimulus, and hey, a weakening dollar all by itself makes it easier for money to flow around the world. Every single one of these is a major boost to liquidity.
Okay, so with all of that in mind, where are we right now? Well, as I'm recording this, Bitcoin's kind of hovering around $90,000. After that crash, it feels a little stuck, right? But what if I told you the market is completely, utterly mispricing it?
Because here's the crucial point. Based on current liquidity conditions alone, just what we have today, Raul's model suggests Bitcoin's fair value is actually closer to $140,000. This massive gap between the actual price and the model price, that's what he calls the alligator jaws, and he believes it's only a matter of time before they snap shut, and probably pretty violently.
So if liquidity is the fuel, how does it actually move through the market? Well, it's not random. There's a pretty predictable sequence, like a series of dominoes that fall in a very specific order. And this is what he calls the everything code. It's a sequence you can actually follow. First, financial conditions ease up, and gold is the very first asset to sniff this out. It's kind of like the canary in the coal mine. Then, the dollar weakens, which causes global liquidity to rise, and only then does that capital really start to flood into crypto, with Bitcoin leading the charge. This is why watching gold is so important. It's a leading indicator for crypto with about a 9-month lead time.
Okay, so once that liquidity hits Bitcoin, what happens next? Well, the capital doesn't just stop there. It starts to move, and understanding how it moves is the key to navigating what comes next in the cycle.
This movement is all dictated by what we call the risk curve. Just think of it as a spectrum, right? On one end, you have the least risky asset, which is Bitcoin. And on the far, far other end, you've got the most speculative stuff out there, like brand new meme coins. Everything else, Ethereum, Solana, other altcoins, they all sit somewhere in between. During a crash like the one we just had, liquidity gets pulled out violently. And the assets that are further out on that risk curve, they get hit the absolute hardest. So if Bitcoin falls 30%, yeah, it's painful, but you can expect Ethereum to fall 40% and some smaller altcoin to fall 65% or even more. It feels totally brutal, but it's a predictable part of how the risk curve works. But the reverse is also true. When liquidity comes back and the business cycle starts picking up, people get more confident. They've got more money to play with, and that capital starts looking for higher returns. So it flows out the risk curve, from Bitcoin into Ethereum, into Solana, and beyond. This is what everybody calls alt season. But navigating this part is tricky. Raul's advice is basically to ignore the hype, ignore the fast-moving stories. Instead, anchor your portfolio in established networks that have proven adoption like Ethereum and Solana. And then, for any other project, just ask yourself one simple, powerful question. If I zoom way out, is this thing likely to even survive in the long run?
So let's bring it all back together. When you combine that perfect storm of the sell-off with the underlying liquidity dynamics that are going on, a whole new picture starts to emerge. This was a reset, not a reversal. The bull market thesis didn't actually break.
It was a stress test, a really rapid, painful, but ultimately necessary event that cleared out all that extreme leverage and just reset expectations. It shook out all the weak hands, and it prepared the market for the next phase, which, if those liquidity models are right, is still on its way. The sell-off didn't kill the bull case. In a lot of ways, it actually reinforced it by cleaning up the whole system. And that really just leaves us with the final and most crucial question. Did this brutal move shake you out of the market for good? Or did it wake you up to the underlying mechanics of how these cycles really work, and maybe even prepare you for what could be coming next?